Hi, this is Karen Lin. This video is to explain the intra-entity sales of the land and depreciable assets. Let's first talk about intra-entity sales of land. The logic of intra-entity sales of land is similar to the sales of inventory between the parent and the sub, but the difference is that the buyer of the land is usually not selling the land to the outsiders in the near future. That means the unrealized gain in the intra-entity sales of land will stay in the group for a longer time than if it is intra-entity sales of inventory, which is made, usually the sales is made the next year. I'm going to use a case to illustrate how the intra-entity sales of land works in consolidation. So let's assume there's a seller selling a land to the buyer, $60,000 land sold for $100,000. So there's a markup of $40,000 by the seller. We can see that there's a cash changing hands from the buyer to the seller, and the land was marked up from $60,000 to $100,000. So let's look at accounting. Okay, so let's look at the parent and the sub. Let's assume parent sold to the sub. The direction doesn't really matter right now because I'm just going to illustrate the unrealized gain part. So 60,000 of the land sold for 100,000, but it didn't get sold out to the outsiders. So there's not really a transaction happens in the group's point of view. So let's look at accounting. We can see parent and sub, right? So there is land here, and there is a gain. So the parent used to have a land, now it's gone. The sub has a $100,000 land. The parent recognized $40,000 gain because of the markup, and the sub does not have gain. If we look at consolidated number, right, we will see that what is the cost of the land to the whole group's point of view? It is 60, right? It is only the resources that coming in and or out the group that counts. So consolidated land should be 60, and there should be no gain because there's nothing sold to the outsiders. From this chart, we can see that there is adjustment needed for each row. For the land, it was 100. It was 100 on the subsidiaries book, but on the consolidated financial statement, it's 60. So we actually need to adjust for negative 40, which is a credit 40 to the land. The gain should be gone. So the gain has a credit balance. We need to debit 40, right? So now from here, we can see that if I said there's a debit or a credit, we need to debit 40 of the gain and credit 40 to the land. Now, this is called TL, transfer of land. TL means transfer of land. So this is the first year, right? The first year, we need to do this adjustment. The second year, everything works the same. So now I'm going to just erase these numbers. We will see that there's no more gain because the gain is gone. There's no more gain here because the gain is gone. The next year, let me show it here. So we are still having this land, and the gain is gone, so it should be retained earnings. So let me write it clearly. So the land is not on the parent's book, it's on the sub's book. Consolidated should be 60. And the retained earnings, the parent has this, because it's the seller, so the parent's retained earnings has the 40. However, from the group's point of view, there is no gain there, right? So we should see this is the book. All right, so because of this, again, if we look at this panel, we still need 40 here, credit, and we need to debit 40 in the retained earnings. So we need to debit 40 to the land, credit 40 to the retained earnings 1/1 of the seller, okay? This entry is called GL star, which means it comes from previous years. Now, we go back to our original point when we talk about intra-entity inventory sales. The direction actually matters. So we need to know the direction of the sales to determine the star GL, which is the gain of selling of land from the previous year. So let me take away this. So if it's a upstream sales, the star GL, it would be debit retained earnings 1/1 of the sub, because it's upstream sales from the sub to the parents, the 40. We want to credit the land to adjust the land to the 60, which is the original cost. If it's downstream, right, the credit side is still the land, but you want to debit the investment account, 40, and still credit the land, 40. So this is the intra-entity sales of land when there's upstream or downstream sales. So let's recap what we have just learned. If when we have intra-entity transactions of land, we basically want for the first year, this is the first year, we want to credit the land and debit the gain on the sales of land. This will reduce the markup of the land to the original historical cost in the whole group's point of view, and also remove the gain of the sales of land between the two companies. The debit and credit these amounts are the gains, the full gains on the intra-entity sales of land, which is here, the gain. Okay, this entry is called TL. The next year, which is the second year, you want to debit retained earnings 1/1 if it's upstream, or investment if it's downstream. For the whole gain, right, the whole gain we get from the first year. This entry is called Start GL. Start GL means gain of transfer of land, and star means the gain is unrealized from last period. Finally, at the year of sales, we want to eliminate the unrealized gain, because now the unrealized gain is finally realized. So we want to debit retained earnings 1/1 of the sub or investment depending on the direction of the sales, and then we want to credit the gain of sales of land. All right, what does this mean? This is similar to the unrealized gain realized in the period of sales of inventory, where we actually basically take the unrealized gain, the 40,000, from the period previous period because it's retained earnings 1-1 or investment, and then put this 40,000 K to this year. Okay, this is previous year. Want to put the previous year's gain to this year. So that's why you can see there is a credit of gain. Now again, I just want to remind you, these entries are made on the consolidated financial statement because it's what we did previously, right? If you look at what we did previously, you can see that we didn't change the book. This is the book. In both year one and year two, which is black and red, year one, it's on the subs book, it's 100,000, and then we adjust it to the 60. The second year, it's 100 again on the subsidiaries book, so we need to adjust another 40 to make it 60 again. So again and again, we do this similar, the same entries until we sold the land. So when we sold the land, so this is first year, this is second year, or the years after, and in the final year, when the land is sold, you wanna the land in retained earnings 1-1 or investment, right? I'm just going to use retained earnings 1-1 for consistency. The final year. You can see now it's all gone. Okay, it's not on the parent's book, it's not on the subsidiaries book, and it's the consolidated number should be 0 too, and there's no adjustment needed. But the retained earnings 1-1, the parent already acknowledged the 40 in the book, so it's always 40 because it's already recognized on the seller's book. But from the consolidated, from the group's point of view, they shouldn't be recognized in the previous period, so it's always 0. But this period, because we sold it, there should be a gain. I'm sorry, should be a gain. And this gain in the consolidated group's point of view should be 40, but it was not recognized on either the parent or the subs book, right? So we want to realize this unrealized gain. You want to debit, you want to eliminate this 40 and then add 40 to the gains. So you want to debit retained earnings 1-140, credit the gain 40 to make it realized in this period. Also, I want to say that because I use the downstream as an example, so it should be investment rather than retained earnings 1-1, but I'm using this example just to illustrate that it should be on the seller's retained earnings 1-1, which is the parent in this case. However, because it's downstream, if it's downstream, the parent actually recognizing its gain, but it shouldn't be realized only because of this investment relationship. That's why we should debit investment rather than retained earnings 1-1. I think we talk about this when we talk about the inventory sales. This is similar. All right, this concludes this intra-entity sales of land, and I hope you understand the logic. If you still have some problems, you should practice more and practice on the after tax examples. Okay, good luck.